Hello everyone, how's it going? So in this video, we're going to talk about ENDP, ENDO International PLC, a pharmaceutical company based in Ireland, the Republic of Ireland. So let's start with the beginning. Why were people attracted in this company? Why is it even a thing? It's because of its price volatility and because people saw how low it got. That was the initial reason. Of course, the fundamentals and the rest of the market's conditions also would matter, but in my opinion, what attracted people in the first place was the company's own situation, not the fundamentals. Actually, if we look at its fundamentals, it may even play against Endo. So, look, the company's specific issues are lawsuits, Chapter 11, and the size of its debt, right? But people they like to see what is special. They like to see what is like out of the normal. So as far as Endo is concerned, it has attracted some investors towards the very end of its period of time when it was still listed on the Nasdaq. A bit like people trying to scoop the bottom, but they didn't really scoop at the bottom. You see what I mean? I don't know if you guys remember back when the Luna coin absolutely collapsed. Some people, like I'm talking about YouTubers, the people who bring like crypto analysis channels. Well, some of them were like, "Oh, you know what? Luna is now $12. Maybe it's time to scoop the bottom, right?" And then they bought a bunch. And the implication here is that they do believe that that was the bottom. Obviously, it's not the bottom. Not at all. Like, very far from it. I would be very happy to see Luna going back to like $1 at the moment. And yet, there was this meme before that says, you know, Luna would go to $1 before USDC does. So, you know, that's it's quite funny, but until you have a lot of money in in this coin. So I hope none of you do. So this is the company specific issues. The lawsuit, the liability, it's the fact that it wasn't doing very well. And also the sector certainly doesn't help. It's pharmaceutical. It's a small pharmaceutical company. It has a lot of uncertainty in its continuity in operations, and it's been affected by the capital flight. Could it be also affected by, you know, the current situation in the United Kingdom? I think not. I think that most of the reasons why the stock is suffering is because of the ongoing lawsuit and the Chapter 11. Just saying though, Chapter 11 is not like Chapter 7. Like in many countries, when companies go bankrupt, it's the end of the road, right? It's going to be everything liquidated, people laid off, this building sold off, we would be left liquidating the furnitures, so on and so forth. Like, I'm sure that in many cities where you live, if you are well informed enough, you would find like computer shops that almost wholesale laptops or that wholesale like internet cafe computers. Is because when a business goes out of business, they have to liquidate those equipment, and there are some specialized places to do these. So if you actually know a place like that, then it's actually quite worth it to try to see if you can snipe some of those goodies, like, you know, video cards and laptops and so on. Sorry, that's a little bit of a tangent, but my point is, in many countries, when people say bankruptcy, then it's quite literally the equivalent of Chapter 7. Full liquidation, there is no, you know, there's no tomorrow, and there's also no potential redemption. But in Chapter 11, it simply means that the company will undergo a period of, I don't know, like parlay. Like people will start negotiating what's going to be the future of the company because, hint, hint, it's not going to go well if we stick to the current plan, right? Now, at the moment, the future of ENDO depends largely on how well the negotiations would go. In my opinion, the equity holders are usually the biggest losers in this kind of scenario, but anything is better than nothing. And the good news is, the price action is currently very close to nothing at all, right? It has already gone through huge deflations, huge sell-offs. So the big loss that we've mentioned, if you haven't gotten into ENDO, it may have already been behind us. In other words, it's possible that things have bottomed out. Now, this is the good news, and of course, it's a bit easy to say, with the benefit of hindsight, that it has fallen down so much, right? But in my opinion, at least the big chunk of the sell-off is actually behind us. Now, this is the good news. What is the bad news? The bad news is things can still go very sour. Maybe the bondholders would be like, you know what? Instead of having another few years of unknown, we want to have the certainty of getting paid now, even if it's just pennies on the dollars or fractions of pennies on a dollar, right? So for those people, if they vote to say we want to go into liquidation phase, then it's completely over. So if you decide to buy in now, the loss would be whatever your entry price in its totality. So this is definitely something that you have to remember going in. And the question remains, can it bounce back? Well, I would say that the restructure is not just due to the contingency loss, but also to its massive debt, right? So the most realistic scenario is if they manage to pull it through and that the company continues to live, they will take a bit of time before coming back, because they have basically emptied out any sort of, they would have basically emptied out every sort of possible upward space if the restructure is successful, because the company has to survive first before satisfying the demand of its investors. I mean, this is something that we cannot just overlook, right? It's possible that this company will remain in a it may remain in a relatively dormant and bite-sized type of situation. So it needs to have additional catalysts to push it back to somewhere that's respectable. And even then, it really depends on what you mean by respectable. In my opinion, if it can go back up to $1, it's already something. It's already something. And we may not be able to see this for a long time. If you guys remember what happened with PaySafe and Hyliion, the grind can go on for quite a bit, and without any sort of actual reason why it is the way it is, right? So this process could take some time. It could take years. But for the investors, or in this case, rather traders, who want to get in, now is one of the good time to get in, with the assumption that the restructuring will go well, and they're going to be able to reset from almost zero, and to continue growing from where they are. You have to remember that right now, everyone is saying this stock is done for. This stock is over. But it's precisely in moments like those that I would say that looking at them favorably to determine if you want to have some exposure in this kind of highly deflated situation is good, right? This is a bit like, imagine we're in Berlin in 1946 and you start buying up real estate. Or imagine if you're in East Germany in 1990 and you want to start buying real estate, right? Obviously, no one would do this kind of thing, or at least no one in the mainstream will tell you to do this kind of stuff because it's super risky. But at the same time, this is the kind of place where moonshots could potentially happen. Just some food for thought. Now, in every single one of my video, I obviously say that all the advice that I give you is just for entertainment purposes. I'm not someone trained to do this. I'm not your investment advisor, blah blah blah. But in this kind of videos for this kind of stock, I think that it's actually relevant to remind you with more emphasis that my opinions are just that. They're opinions. You definitely have to do your own homework, and you have to take a good hard look at your own portfolio to see if it can afford to have something like ENDO. So it's really up to you. If you're very risk tolerant or risk taking, if you're willing to go on the wild rides and moonshots, then I would say definitely go for it. And ENDO is one of the decent options at its current price point. How much would I recommend you to risk? Less than 1% for sure. And for some people, even less than 0.5%. Because there is significant risk attached to it. And I don't want you to, dump in 50% of your life savings and be like, I'm going to YOLO this. No. This is not one of those stocks that you can YOLO, right? So just absolutely never do this with your life savings. So 0.5 to 1% of maximum exposure is what I would recommend. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.